Joining us to analyze the implications of the MPC's decisions for the fixed income market is Kizito Odunze, a bond sales analyst at Dunn Loren Merrifield. Kizito, thank you very much for joining us. So no major surprises out of the MPC's committee this time, but your thoughts about what this could mean for the market. We've seen some stability recently in the bond market and, of course, in the T-bill market.
Thank you, Wole, for having me. As I said, there are no surprises in MPC decisions at the recent MPC meeting. Most indices or most rates were held at status quo, and as expected, the market had actually gone into a slight lull in anticipation of what will happen, given that nothing has changed. So we expect a continuation of market activities and continuation of trading in the market per se. As regards the fixed income market, rates had remained relatively stable up to this day, and even though of recent we had noticed a bullish run within the past 1 month to 3 weeks to 1 month. So it's interesting to anticipate what will happen next, given that there have been no changes.
One element, if I can just chip in here, is the plan for the AMCON bonds. I think that has been clearly stated now. ₦1 trillion worth of bonds are maturing in December, and the plan is to simply give the bondholders treasury bills. Your thoughts about what this could mean for the markets and how this is likely to impact perhaps the T-bill market going forward?
Yeah, Wole, there are several permutations as to how that would play operationally. The CBN governor mentioned that the redemption will be by way of treasuries. Now, there are a couple of questions that can be asked. What length of treasuries? What will the trading rules regarding those treasuries be? For instance, we all know that if the treasuries that are issued as redemption for those bonds are immediately tradable, there's a likelihood that there will be surplus supply and yields in the market would go up significantly. There's also the case of partial or complete, what's it called? Partial or complete trading of those bills or redemption at the discount window. One expects, however, that there will be some kind of restriction, because it would be a futile effort for the CBN to have to start mopping up all that liquidity, given also the extent of OMO bills that are available out there that would also mature in the coming year. We remember that the CBN governor mentioned that next year there are indications that there will be reason for tightening. I don't think the CBN would want to shoot itself in the foot by not taking care of this by way of the AMCON bond. So we expect those bills would most likely have some kind of embargo, for want of a better word, on their ability to be traded or discounted.
Right. Okay, let's talk a bit about what's happening more recently in the market. We've seen the federal allocations provide more liquidity recently, and I want to get your thoughts about how this is likely to impact the market going into next week.
Going into next week, we expect that the drop in yields that was occasioned by the inflow of about 281 billion of FAC funds into the system, that dropped yields from rates from 14%, circa 14% last week to 10.5% this week, would sustain for the remainder of the week, possibly even into next week, barring any new liquidity issues that might arise. If the market isn't blindsided by any unforeseen liquidity issues, then we expect that the rates would remain at this 10.5 levels for the rest of this week and into next week.